Hello and welcome to Fireside Chats on Nomura Podcasts. I'm your host, Jordan Rochester from the Global Markets Research Team. And in this episode of our Fireside, I'll be talking with Jing Wang from the China Economics Team on what to make of China's dual circulation strategy and how it could feed through to the economic outlook. I'll be asking Jing, what are the key components of this new strategy and what will it mean for China's economic outlook? And of course, how will this feed through to global markets? Now, it's not the first time we've seen big initiatives from China. We had the Belt and Road Initiative announced back in 2013, the Made in China 2025, and various other strategic 5-year plans over the years as well. So for background, Jing, I have to ask you, what is this dual circulation strategy? How does it compare? And what makes it different to the previous plans we've seen from China? Is this a replacement like for the Belt and Road Initiative, or is it something else?
Hi, Jordan. Thanks for having me, and it is great to be here. For China's dual circulation strategy, or you call it DCS, it was first introduced by China's President Xi Jinping in May of this year, when the rest of the world is still fighting the COVID-19 pandemic, and the U.S.-China relationship continued to worsen. Put in a simple way, the DCS is just a combination of import substitution and the domestic demand expansion. Compared to previous plans, the DCS is perceived as a short-term program in responding to the ongoing pandemic and a multi-year strategy to cut China's reliance on some key high-tech imports, and therefore reduce its dependence on external demand to achieve China's growth sustainability. It is also a recognition that an over-reliance on global supply chain could present a risk for China. Therefore, the DCS marks a slowdown or even a withdrawal from some of China's ambitious global expansion plans, such as Belt and Road Initiative. But it is also not a retreat from its plan to open up to the world.
Well, then let's dig into the specifics of that, because that's actually a really big deal. It could mark a turning point for the sort of trends we've seen with globalization. So what does dual circulation, DCS, that strategy mean in practice? There's two sides to it. That, from what I can see, there's the internal circulation, so what it means for China's economy, and then there's the international side of it for the rest of the world. And by circulation, I'm referring to the economies we're considering here. Let's focus on China first. So, Jing, what are the key parts of the internal circulation strategy?
Yeah, actually, the Chinese government does not provide official definition for what is actually for DCS. However, the Econ 101 classes teach us the supply and demand are the basic building blocks of all economies and naturally balance each other out. So for internal circulation, it simply means the interactions between domestic demand and domestic supply, or just meeting domestic demand with domestic supply. So, and for the external circulation, it is just another way of saying international trade and cross-border investment. Since China opened itself to the Western world from late 1970s, so the external circulation does not appear to suggest any new plan strategy. Moreover, although the Chinese government continued to reiterate the importance of both internal and external circulation, we believe China will just strive to increasingly rely more on this internal circulation under this DCS. So as I mentioned, in practice, this DCS could be just broadly defined as a combination of import substitution and domestic demand expansion.
These sorts of ideas have been knocking around for a lot of countries for quite some time. Most developed countries and emerging market countries have an industrial plan in place. And part of the plan for emerging markets is trying to escape the middle income trap. But that really depends on the actions they take, and it's also fighting the forces of globalization at the same time. What are the key headlines that you'll be watching out for, Jing, to know that this new strategy is working and running at full speed?
Yeah, Actually, this the main idea of this DCS is not new. We focus on more of those actionable strategies. So we would be looking at the three main strategies to see whether this strategy is running at a full speed. First is whether China is gonna significantly reduce its food and energy imports. Second, whether China is gonna advance its high-end chips making or high-end manufacturing sector. Third, whether China is gonna reduce some of its international lendings or investment or withdraw from this Belt and Road Initiative.
Well, let's look into that because they are the aims, but how will they achieve that with actions? So let's first start with reducing food and energy imports. How will China achieve that? It's one of the world's largest global populations.
Sure, yeah. First, on food, as you mentioned, China has the largest population in the world, and nearly 20% of China's food consumption is imported, mainly soybeans. To reduce its important dependence on food imports, one key strategy we believe to speed up urbanization by encouraging the development of central cities and city clusters. This strategy could improve the efficiency of land use in urban areas, at the same time help protect farmland to cap or even reduce China's food imports. Of course, China can always scale up agricultural mechanization and automation and enhance the strategic reserve systems for agricultural goods and reduce food waste. And for energy, China's also is a very big energy consumption. China is also a very big energy consumer, and its energy consumption has surged over the past decade, especially for crude oil. Based on our estimates, in 2019, China's import dependence for crude oil has already exceeded 70%. So to reduce the dependence on energy imports, we believe China could raise the capacity of strategic energy reserves, especially for crude oil, so that China could import more energy products during the period of low prices. China could also encourage more investment in clean energies, including wind, solar, nuclear, and hydropower. Last but certainly not least, China could promote the use of energy-saving equipment and clean energy power equipment, such as electric vehicles.
Well, let's talk about the other aim, which is a big aim, and it's part of the future, which is high-end chip manufacturing. We've already seen China in the past talk about this. I've seen many articles about China trying to become self-reliant on its own chip manufacturing. Now, in this sort of COVID-19 situation, we've seen the credit impulse of China pick up as well. In this part of the recovery of the business cycle, that's quite normal, thanks to COVID-19 accelerating the need for it. So what will China do to achieve this aim, Jing? Will it be more fiscal stimulus, or are there other aspects to this strategy? Because I want to bring up a chart here which kind of makes the point clearer. It's from the report you guys had on the dual circulation strategy. It's the share of imported integrated circuits in total imports. Now, if you're listening to this on a podcast rather than the video, don't worry, folks. It's basically a straight line higher with a pause between 2006 to 2012. And roughly 16% share of the imported integrated circuits. That is 16% of China's total imports is in circuits, essentially, which is a substantially higher number than I thought it would be. And the trend is not going down, it's going up. So what's the plan here, Jing, and how will China achieve this aim?
Yes, definitely develop the high-end manufacturing, especially microchips, is a key component for this dual circulation strategy. And this requires large support from the government. So therefore, although this COVID-19 has largely receded in China, we expect on the fiscal front, the fiscal deficit only modestly decline next year or in coming years to support the development of high-end manufacturing sector. So other than the direct fiscal support, we believe the Chinese government will use two main strategies to channel more funding to high-tech manufacturing sector. First of all, Beijing is more determined than ever to develop China's NASDAQ to help high-end companies to directly raise funds in the capital markets. Secondly, the property sector, which absorbed almost half of the new credit over past easing cycles, will likely be significantly contained in this or the future easing cycles, so that more funding could be provided for the high-end manufacturing sector.
Well, let's talk about the other part of the strategy you think will be implemented, which is on international lending and investment as well. What's the plan here? Is it to increase it, reduce it? And if they are going to reduce it, what sort of barriers are going to be used to slow it down?
Yes. So the one very typical example for this international lending and investment is China's previously announced Belt and Road Initiative. So under this DCS, we believe Beijing would likely slow down its promotion of this Belt and Road Initiative. So this is also actually called China's Marshall Plan by the markets. The main reason for Beijing to downplay this BRI under the DCS is that Beijing's pockets are not as deep as they once were. The first, there are a couple of reasons. First of all, it's due to this large capital outflows in 2015 and 2016. Beijing's pockets are no longer as deep as before, with FX reserve declining by around 800 billion US dollars from its peak in the middle of 2014. Now it's only about 3 trillion US dollars. Second, the worsening US-China relationship has made Beijing more cautious in extending its global reaches. Third, the returns on the BRI projects may not also meet the initial expectations. So that's why we expect Beijing to possibly retreat from this BRI strategy.
Well, let's talk about the strategy overall then, the DCS strategy. I want to ask you about the risks to it. And there's the political risks, there's the economic risks, whichever one you think is more important. On the political side, I remember when the Made in China 2025 plan really did catch the attention of US trade representatives for quite some time. In 2018, when we were wondering whether trade wars would escalate, I remember looking through a report from the USTR on China, and Made in China 2025 featured in that quite a lot. It was mentioned several times as their reasoning for raising tariffs on China, as well as other aspects. Are we walking down the same path? Do we have the same risks ahead, or is it more on the economic side we should be focused rather than the politics?
So I think we for now we could just focus on the economic side. First, actually, although the DCS is seems like a natural choice for Beijing, but it is also a reluctant one because China faces both rising tensions with existing global powers and with the pandemic. Although Beijing has clarified several times that the DCS does not represent a shift towards isolationism, the risk of turning inward cannot be ignored. Actually, China, many of this success of China's development was attributed to its economic opening in late 1970s, and it still have some catching up to do. Also, there are some specific risks in the short to medium term, because the property sector is very important, accounting for 25%, around 25% of China's GDP. Restraining the fundings for this property sector could backfire and force Beijing to soften its hawkish stance on the property developers. And second, massive government subsidies for the chip-making sectors or chip-making investment could invite the rent-seeking by the private sector, state-owned enterprises, and the local governments. That could lead to potentially inefficient investment and bad loans.
Well, okay, then you mentioned quite a few risks there. Let's talk about the economic impact of this strategy and how this feeds through into your view on China. What is the team's view on Chinese growth right now for this year, next year? And then this strategy will start to feed into that view at some point, and how will it feed into that view?
Yeah, so currently with COVID-19 being largely under control in China, China's growth recovery has been largely on track. So for next year, we expect China's economy to be further supported by a favorable low base effect and the continued recovery in the consumption sector, especially from the hospitality sector. So we expect China's real GDP growth could rise to around 9.0% for next year, and the CPI inflation could stay around 1.0%. So the overall this high growth improves fundamentals, and while low inflation will provide more policy more room for policy support. And the good recovery of this domestic economy could enhance China to implement the DCS, especially in terms of this domestic demand expansion.
Well, you mentioned inflation there. That's something I was going to bring up because the moves in Chinese inflation this year have been pretty dramatic. It's been dramatic for most countries, but from 5.4% in the first quarter of this year to now around 0.5%. It's a big fall, nearly a 5% swing either way. With such a big swing, the volatility of inflation is a factor to consider here as well. You mentioned 1%. Is that the view? So is that the view for inflation next year? 1%, is it? Or is the view of perhaps a higher inflation ahead?
Yeah, so actually, CPI inflation has been declining over the past several months. But the decline in CPI inflation does not mean China is experiencing disinflation or deflation. The drop in the inflation was mainly driven by the pork prices, which was due to the high basis as a result of the African swine fever last year. And the second, the sequentially weaker pork prices and the increased weighting of pork in the CPI basket. In fact, excluding pork, the CPI inflation actually bottomed out in July at around 0.4% year on year and remained stable at 0.7% between August and October, despite the negative PPI inflation, which was driven by the sharp lower global oil prices. Next year, in 2021, we expect CPI inflation to remain subdued. First, on this, as the food price inflation may continue to soften, although the PPI inflation may pick up on this recovery in the crude oil prices with effective vaccines widely available.
Well, yeah, you mentioned the inflation outlook there. In terms of the risks for the market, for me, on my side at least, it's if next year has a high level of inflation globally, as the recovery back to normal phase might have. It might just be a one-off shock and then it settles back down again. Just talking globally here. And the risks are whether central banks get hawkish on the back of that. In my space, in the euro area, I doubt that will be the case. But when it comes to the PBOC, there's been some market commentary that I've seen. There's been some concerns over whether the PBOC could actually look even to raise rates at some point. And apparently that's following some hawkish comments by PBOC officials. Is that something that you're keeping an eye out for and should be wary of?
Yeah, here is what we think. Considering the strength of the growth recovery in recent months, it would be natural to conclude that Beijing does not need to ramp up its stimulus further. But however, at the same time, it seems to us it is also too early to start tightening, given the second wave of COVID-19 affecting the economies across the globe. Overall, we firmly believe Beijing will maintain the status quo by neither stepping up nor rolling back major stimulus measures. And in specifics, we expect neither hikes nor cuts, or either policy rates or triple R's. But here we want to the key indicator we follow is the credit growth for China, which is the year-on-year growth rate of agri financing. This we view as the most important intermediate policy target. So in our view, we expect the credit growth to stay near current levels, between 13% and 14%, and it may soften to 12% towards of next year.
Well, then you mentioned the risks there in terms of the sort of inflation, the growth outlook, and then the credit cycle. I think that's a really important part to this because everywhere has expanded their credit base really during this COVID-19 crisis. But in China, it really matters for the housing market as well. And despite what's happened with COVID-19 and all of that, we've had massive stimulus, and Beijing has maintained its hawkish stance on the property sector when it comes to the regulation side. And that's kind of due to the concerns that we're seeing, right? There's a talk of a property bubble and the consequent financial risks from that. Is that where the risks are for China? Is there a property market bubble here where investors should start to be wary of it?
Yeah, as already discussed, the property sector is a very important sector for China. And actually, the property sector has been a key growth driver for China's economic recovery post-COVID-19. Many thanks to monetary and credit easing measures, pent-up demand, and inflation-led demand for the properties. And if we look at more details by city tiers, the big cities have been leading the recovery of this property sector and even started to show some signs of overheating, suggested by faster rising pace in property prices and the land price there. However, overly bullish property market is clearly not fitting well into Beijing's new thinking of dual circulation strategy, and there's a long-term mechanism designed for the property sector. So therefore, the Beijing has to take a tougher stance on the property sector, especially in the property financing. And actually, we have already seen some cooling of the land sales in big cities in recent months. Although the property sector was not included in the Beijing stimulus package to fight the COVID-19. It was widely reported that the property bond financing could be contained, and the bank loan quotas for the property sectors could be also lowered. The recently hyped the three red lines. We could have more details for that next year, and that could force the property developers to reduce their debt levels. But however, as China has not fully recovered from the pandemic yet, and the rest of the world is still fight this COVID-19, we believe the market should not worry about over tightening in the property sector, and also Beijing still need to advance its urbanization. So a healthy and stable property sector will be critical for Beijing to achieve that.
Okay, well, let's move then away from the zooming in on the China impact of this DCS strategy. I want to talk a bit more about the global economy because China is one of the largest economies in the world. We've got a strategy being implemented by China here that explicitly could reduce the dependence on high-end technology imports. We've talked about food and energy imports as well, and it could even slow the growth of, or even, dare I say it, cut the overseas lending and investment trends that we've been seeing. Now, if that is what actually happens, it could have a profound impact on globalization, which comes with an economic impact for the rest of the world. Who are the winners? Let's talk about this to begin with. Who are the winners and who are the losers in terms of economies from this strategy being implemented by China for the rest of Asia? Is it a sort of near-term importers and exporters in focus here?
Sure. We believe overall that China's DCS strategy could be negative for Japan, Australia, and the rest of the Asia in the short run. But it could be also positive for some economies on this global value chain diversification in the long run. So first for Japan, as intermediate products and raw materials for electronic manufacturing, including microchips, account for a relatively large share of Japan's exports to China. So China's reduced import dependence on these products could be negative for Japan in the short run. But in the longer run, however, the negative impact from this DCS is likely to diminish and become positive for Japan, as many Japanese manufacturing companies have already started to diversify its supply chain out of China under the threat of the intensifying U.S.-China conflict. That's for Japan. And for Australia, Beijing's shift in focus, of this, moving away from this Belt and Road Initiative and property construction and towards cleaner energy and high-end manufacturing, definitely has some negative implication for Australia. As it is the largest exporter of coal and iron ore globally. The actual impact on Australia will be also depending on the speed and the magnitude of the Beijing's efforts in pushing forward the DCS, because this DCS is a long-term strategy for China. For the rest of the Asian economies, China's DCS could have a adverse impact on Asia's exports of these high-end manufactured products, food and energy. Of course, there will be some beneficiaries as multinational corporations will look for the next manufacturing hub after China. In microchips, just to be a little more specific, we believe Korea and Taiwan will continue to benefit in the short run from these U.S.-China tensions, given their dominant market status. China's potential retreat from this BRI could have a mixed impact from Asia, as it could be offset with increased investment flows from other developed economies.
It really does matter. For example, in my area, for the Euro area, China is actually the largest trading partner. 22% of the trade-weighted basket is with China. 3% of German GDP is just exports to China. So any move away from EU imports into China would weigh on the outlook. It's just hard to quantify whether this is something for next year, or is it something that we'll probably look back on in 5 years' time and see the impact? I think it's probably the latter, but it will feed through to perhaps weighing on European output if it's accelerated, if this plan is really put into action from next year. Well, let's talk about the impact of the plan. But for markets this time, we've got China moving away from import dependence in several sectors. You mentioned it will impact Australia and Japan and several other Asian economies as well there. It will take some time to adjust to this as well. So how will China make this adjustment? Is it more fiscal? It seems to me the answer is yes, but less outflows. And therefore, do we start to see steeper curves? What does this mean for the currency as well, Jing?
Yeah. So as we discussed, we view this China's DCS as a longer term strategy. So this may not have a significant near term market implications, but we believe this could gradually become more important factor for in shaping this monetary and fiscal policies and rates and the currency. First on the monetary policy. We, as I mentioned, so because China need a reasonably good environment with not very high financing cost to support this manufacturing sector. So maybe China is gonna maintain its current interest level, which has already returned to the pre-COVID-19 levels. So that's why we don't think PBOC is gonna tighten the policy rate anytime soon, unless there will be some clear sign of overheating for the economy. So this suggests we the front end swap rates and the bond yield should be kept, and considering the amount of term premium already priced in. The second, for the fiscal policy, as we discussed before, to support this DCS strategy, we still need some supportive fiscal policy environment. So the DCS could potentially impact China's rates via the bond supply dynamics. And because we expected the fiscal deficit during post-COVID-19 only to decline modestly, so this could result in so that could eventually lead to a higher supply of a higher grade bond. So that could pressure the long end of the bond curve and result in long end yields underperforming the front end. So that could lead to a story of steepener.
Well, with all of that, Jing, it's a wrap. And thank you very much for your time today.
Yeah, thank you.
So those are the views from us, those are the trades from us, and that's the Fireside with Jing. Thank you for listening into the podcast. If you enjoyed listening to the show or want to hear more from Nomura's economists, researchers, and investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. If you're feeling generous, please do leave a review on your podcast store of choice, preferably a nice one. And please do log on to nomuraconnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.